Okay, we're going to start today by looking at the S&P 500. You can see that we um, we are we have a lot of support here at the 100-day moving average, which is the green line right here. And you can see that we're oversold. We're totally oversold at 10 um, in the stochastics. So we have a good combination. And it seems like on Friday it bounced off of that 100-day moving average and it's up just a little bit. Um, if we look at our stochastics chart for the S&P, you can see that we started a downtrend. Right here, we broke out of a multi-month uptrend that was like the perfect uptrend where it's had support at the bottom of its trend line. And so right now we're kind of wondering in the stock market, are we going to continue this downtrend or could the seasonal factors bring us back up here to continue this uptrend? We don't know. That's we're gonna find out this week. So if we look at our calendar, you can see that we are right here in the middle of right at the end of earnings season. We had NVIDIA report their earnings. They were really good, but the stock went down after the earnings. And we have the holiday of Thanksgiving coming up this Thursday. So people usually are a little bit positive around the holidays. So let's see if that happens. Um, we have we had end of we have options expiration this Friday. So there was a lot of volatility, and you have to expect that on the options expiration days. Um, Next month, look what we have forward. Look what we have to look forward to. We have the Fed meeting dates. That's 17th and 18th. They're probably not going to do anything because there's not a whole lot of economic data. The government was shut down, so a lot of reports that usually come out did not. So it's going to be really hard for the Fed to do anything um, for a while because of that. And we have triple witching, which is once every quarter, we have a lot of stocks with stock expirations at the same time. So there's a lot of volatility expected that date. We have Christmas, and usually this time before Christmas, the stock market goes up. So we always look forward to that. And we have a double whammy of two holidays very close to each other. So usually people are doing some end of the year portfolio changes and usually that's positive. So we look forward to December being a really positive month, as is January. And February is traditionally not that great of a month. There's some people that say it's because of seasonality in New York, where a lot of trading happens. It's kind of cold out, and there's not a whole lot of um, good spirits around. So let's look at the seasonality. We usually have a positive stock market in the last 3 months of the year, and November has traditionally been one of the best months seasonality wise. And we have volatility going down as the year progresses towards the end of the year. So November, December, we don't have as much gyrations in the stock market, so that's great. Um, let's look at the earnings reports that happened this week. We had Home Depot, we had NVIDIA, we had Walmart. Walmart actually is really outperforming. It's doing really good recently. It had a good earnings report and it went up. NVIDIA, they had stellar earnings, but the stock went down after earnings. So we'll see what happens there. There's a lot of questions, uncertainty about the AI trade. So we'll see what happens to NVIDIA. This coming week, we have Dell reporting their earnings after close on Tuesday. That's about it. And that wraps up basically the entire earnings season for the S&P 500. Um, so, and of course, on Thursday, we have Thanksgiving. So let's look at some of our numbers for this week. We have the 10-year down 2%. And if we look at the chart of the 10-year, you can see that the 10-year has been going down. And as the 10-year goes down, the stock market's been going down with it. So this is the 10-year yield down here, and this is the S&P 500. So, so the reason why this correlation happens, um, it's a one-to-one correlation. Whenever there's selling in the stock market, there's a higher demand for safe investments. So the yield usually goes up whenever the stock market goes up. Um, when a stock market goes down, the yield usually goes down because there's a higher demand for safer investments. So the higher demand for bonds, the lower the price of the yield is. All right, so let's look at, okay, we have 43% of the stocks above the 50-day moving average and 53% above the 200-day moving average. So we are actually declining in momentum. So we have a downtrend starting in the S&P. As you can see in this chart, we have a downtrend in a lot of our stocks also. So let's hope that the seasonality kicks all the stock market and stocks into this continuation of this uptrend. If not, we got to be ready for a protracted downtrend. Right now, we're bouncing off of this 200-day moving, a 100-day moving average, which is very important. But if we go through that, then we have the 200-day moving average waiting. And if that breaks, then we're stuck in a downtrend for a while until we have, maybe until we have earnings again. All right, so let's look at some more things to talk about. So we're when the percentage of the S&P 500 are above the moving average. Right now we're about 50% above the moving average and below the moving average. So we neither have a bullish or bearish market. We have a middle of nowhere market. All right, so let's look at some catalysts for the market to go down. We have a lack of confidence in the AI story, and that's every day we have more and more question marks in the in the AI story. So this may continue to make stocks go down. Potential for tariffs. Um, every day we have a potential for that. But let me see. There's something called a carry trade that might cause a problem in the near term. A carry trade is whenever there's hedge funds that borrow money in another country and they invest that money whenever they invest, they might invest in the United States stock market. And if that unravels in some way, all stocks are going to go down in at the same time. And if that happens, you have to be right. You have to understand that the not every it doesn't necessarily mean the fundamentals of a stock are bad. It just means that there's an unwind in leverage in the stock market, and you have to sit through it. So you have to be ready for that. Um, Let me see. Okay, that's all I had to say about that. So, all right, we already talked about these things. Um, okay, the price of oil is down another 3%. That is, when the price of oil goes down, that helps inflation because that makes the price of almost everything down a little bit. So, and that usually indicates there's a slowing economy around the world and or increase in production. So right now, that'll help inflation. Right now, inflation's still at 3%. Um, and the US dollar is going up. It's actually in an uptrend. If you see this chart, it was in a downtrend until August. And right here, it broke out of that downtrend and is trading sideways. So we won't have any negative impacts or positive impacts of currency on our earnings reports next quarter, it seems. So that's a good relief. Fear and greed index. You can see that we are extreme fear, more fearful than last week. Um, so we were at 22 fear last week, and now we're at 11. So the general market is extremely fearful. We're oversold. This is the perfect time to start to hold your nose and to buy something or don't sell. That's the translation. And right now, the amateur investor is bearish, and it's been bearish for at least 2 weeks now. So our translation is bearish amateur investors means buy or don't sell. Okay, and the VIX. VIX is kind of correlating with that also. There's fear building in the market. The VIX is at 23, and you can see that that means fear is beginning. So people are starting to get afraid the stock market's going to go down. Um, and we have our emotional graph with fear in the market right now. Let me see. All right. Okay, so that's all we had to say for that. Um, right now, the PE ratio for the S&P 500, 25. It's interesting. The the stock market started the year around 25, and we are still at 25 PE. That means 100% of the stock market move this year has been because of earnings. So we're up 14% in general, 12% in the stock market. So that means that the S&P 500 must have had earnings go up 12% because the PE is the same. So maybe we're in a new normal. Maybe the PE ratio is going to be 25 and we grow at 12% in the future. We don't know. But right now, the average PE over the last 80 years is around 16 for the S&P 500. That's around 20% less than we're at right now. All right. So let's look at our first to worst. The best performing sectors of 2024 are still performing well this year, but consumer discretionary was up 30% last year. This year, it's down negative 1%. Let's look at healthcare is actually starting to be an outperformer. It's been the best performing sector so far this month of November. It's up 12% so far this year. And we still have these sectors that did bad last year. They're still doing bad this year. Probably the lowest performing sectors: energy, consumer staples, and materials. Um, so that's always good to look at that. Okay, our theme from this year: investors will reach for stability amid chaos. Um, Utilities did good, probably because of the AI trade. Healthcare has underperformed for 3 years, and believe it or not, healthcare is starting to outperform now. So if we look at our stochastic charts for healthcare, let's look at healthcare. There it is, healthcare. You can see that it took a while, but after 3 years of underperformance, it is starting to outperform. It's overbought right now, and it's the top end of its range. So I wouldn't be surprised if it sold some, so it gets back to the bottom of this trading range. Let me see. So healthcare is outperforming now. Let's look at developed the sector PE's valuations relative to history. You can see that healthcare is now at the 73 percentile, which isn't that bad. Um, Energy is one of the lowest valuations in for the past 30 years. And real estate continues to underperform. So these sectors, whenever there's a bad day in the stock market and the stock market goes down a lot, these stocks have a tendency to go down more because they are the higher valuation sectors, and people gravitate towards the under valued sectors, which are healthcare, real estate, financials, and energy. We'll see if that continues. And okay, let's look at some of the stocks going up and down. We have Ross Stores. We have Align Technology. They make braces. Um, Builders First Source. Okay, we have we have a lot of home builders in this top 10. Mohawk, they make stuff for houses. Lennar, another home builder. So let's see the price, the 10-year. We expect if all of these home building stocks are going up, we expect the yield for the 10-year to go down. Let's see if that's happening. Yes, indeed. We have for the last week, we have the yield going down. So our cheat sheet, if we look at our cheat sheet, yields for the 10-year going down. That's good for home builders. It's good for speculative companies and REITs, small caps, any kind of company that's borrowing money. As the yield goes down, that helps them. Relatively, it's negative for larger caps, tech stocks, financial sectors, and insurers. Okay, so that kind of worked this week. Okay, let's look at the mover. Um, Top decliners. We have Oracle. Oracle has been borrowing a lot of money recently to fund their data centers, and people are getting a little scared of them taking on a lot of debt because their customers are companies that don't have a whole lot of money to pay for that. Like OpenAI is a company that's heavily intertwined with Oracle. So, so there's something called, well, people are afraid that Oracle is not going to be paying back some of the debt they're taking on. That's why they're going down. Vistra, we have a lot of AI related infrastructure stocks, energy related going down. Vistra is an AI related infrastructure build out company. We have Constellation Group, similar. They're an energy company supplying the AI infrastructure. We have CrowdStrike. They make cybersecurity for the AI infrastructure. Broadcom. Okay, we have a lot of AI related stocks in the top holdings here, going down. The ones, let's look at some more of the ones going up. We have some healthcare. We have Moderna. We have, mm, these are all stocks. A lot of these stocks are very low PE ratios. Um, so we have Dow Inc., and they have a really low PE ratio. Um, and they have a high yield. Let me see, we have Black& Decker. This is a home building related company. People buy more hammers whenever there's more home building. So that was the theme today. Let's look at the sectors going up and down. We can guess that the home builders are the number one. Yes, it's up 5%. Everything home builder is up. We have regional banking. That kind of matches our, let me see, regional banking ETF, State Street ETF, oil services, healthcare. Okay, as the interest rates go down, people are going to be reaching for yield. So as the yield goes down, high yielding stocks will benefit because if people get less for a guaranteed investment, like a 10-year of a United States 10-year bond, then people would want to buy more high yielding stocks. So let's see if the high yielding is in the top 10 here. We have telecom, high yielding. We have healthcare, high yielding. Biotech, they benefit from lower interest rates. They are heavily indebted, so they have lower borrowing costs. That makes sense. That is in our list of, it's positive for any any stocks that need to borrow money. Speculative, non-profitable companies. That is biotech. And real estate index. Okay, real estate will benefit from lower interest rates for lower borrowing costs for houses. Um, okay, so that made sense. One's going down the most. Right now, utilities, this is AI infrastructure. It is um, semiconductor technology. Okay, so right now we're basically every day we're in a battle between, let me see, let me get the right slide. Hold on for a second, it'll be worth it. Right here. We're in a battle between infotech, you know, this is the AI trade, basically technology, and then we have some conservative sectors. So right now, this conservative sector's won out, and this sector went down. So keep that in mind. If we do have a protracted downtrend, these stocks will most likely go down the most, these sectors, and these sectors that are undervalued will probably do better. Okay, that was good exercise. Let's look at Dan Now's picks from the beginning of the year. Cisco is continued to super outperform. It doubled the S&P this year. It's up 28%. Why is Cisco going up a lot? There's a lot of deals being made in the AI infrastructure, um, and they're right in the middle of that. And there's a lot of deals that the president is making involving Cisco. They also have a certain amount of money coming in from services now. So that allows predictability in earnings. And let's look at KBWB, the banking ETF. It's up 16%. Cash was probably not a great option this year because it only yields 4%, whereas the S&P in general has gone up 12. Um, okay, so let's look at some charts I pulled out as interesting. The healthcare ETF, it is continuing to outperform. You can see it's at the top end of its range in our little graph here. Don't be surprised if the healthcare starts going down in the zigzag pattern to the bottom end of its trading range right here. And it's overbought right now. So um, as stocks rally towards the end of the year, there might be a lot of people buying some of the more tech-oriented companies towards the end of the year, and this sector might go down a little bit, but it's definitely in an uptrend and it has momentum. A lot of these stocks in this sector have a very low PE ratio, and that is very attractive whenever the stock market is iffy like it has been recently. Let's look at another chart. We have the biotech ETF. I just mentioned the biotech being going up today is one of the best it's a beneficiary of lower interest rates. And you can see that it had a 3 or 4 year downtrend and that broke like right here. And you can see this downtrend, downtrend, down. And now we have this uptrend. So you can see that the sector is outperforming. And it's also being juiced by a lot of deals being made. There are companies buying other companies, which makes a speculative environment, making these companies go up even more. So that's that is the biotech ETF, which is IBB. Let's look at another one. This is Energy Select, and you can see that it's starting to get in an uptrend. It's still um, down for the year. It started the year right here, so it's basically break even down just a little bit. But you can see that this is an underperforming sector. It's a high yielding sector, so um, it is though at the mercy at the price of oil. So we'll watch that. NVIDIA, you can see that NVIDIA has been in an uptrend since early April, late April, but the uptrend is basically we're hitting at 100-day moving average right now, this green line. We're at a major inflection point. We have a lot of support right where we're at right now. You can see we've gone down to that level where it's at right now before, and we're kind of in a sideways pattern. See that right there? And but it's very interesting that NVIDIA posted stellar earnings and it went down that day, and everyone's talking about it. Um, but we are at support right now. Um, if we have, if this NVIDIA breaks through this 100-day moving average, then we'll probably have a continuation of this downtrend where it goes, makes lower highs and lower lows. And this is all like technical oriented. There's a lot of algorithms that follow these patterns. It doesn't mean the stock is bad. We could have a major sell-off in the stock market due to leverage, people borrowing money in different currencies and buying US tech stocks. But if that has to unwind, all the good stocks in America go down with the bad stocks. So we are oversold. Look how oversold. They can't get any more oversold than this. Usually this is a time to buy. So let's see what happens here. It's going to be very interesting. We have a lot of support there. And we do have a seasonality where at the end of the year, NVIDIA is one of the best performing stocks this year. So a lot of managers chase performance. So they might buy this stock to make it in their top portfolio for this year to make them look better. So we'll see. I did a stock screen this week and I highlighted a couple interesting stocks. Micron, it seems like it's still not getting any respect. Um, that's a one-to-one correlation with the AI trade. So if the AI trade continues to go down like it has recently, this stock is going to get cheaper and regardless of its valuation. So I thought it'd be interesting to go over this Goldman Sachs. It's trading at a PEG ratio according to Fidelity of 1.09. So it's right around its fair value. And it's a financial sector. What I like to do is I like to look for stocks. Let's look at our chart here. I always go back to this. Stocks that are in an undervalued sector that's that seems like it's in our screen, that seems like it could have a potential of being like a 10 to 15% grower over time. And you can see that financials are trading at one of its lower um, rank versus history, percentile rank. So let's look at Goldman Sachs. Okay, hold on. Okay. Um, we'll look at Goldman Sachs next, but I also highlighted Uber as being maybe 10% undervalued, and GE Vernova, they do turbines. They make turbines for the AI infrastructure build out, and they have a lot of backlog. Like so, they have very good, of course, earnings visibility. But they've gone down, and they're at a one-to-one correlation with the AI trade. So as that AI trade becomes out of favor, it'll continue to go down regardless of valuation. Let's look at Goldman Sachs. And this is their earnings estimates. They're growing from last year to this year 20%, and then this year to the next year 13, 12%, and then 7% for 27 to 28. So I'm going to say that they're earning they're growing at 13%. And right now their PE is 14, so the PEG ratio is 1.07. That's like a fair value. If you buy it right now, you're buying it at fair value. Um, and their profit margin is three times what we're looking for at 29. Return on equity is right what we're looking for at 13.5. So, and they have um, more cash than they have debt. They have 1 trillion in cash and they have 731 million in debt. So they have 300, 270,000, 270 billion in cash. So that's really great. Banks are kind of interesting. They need to borrow as part of their business. So you can't really make too much out of the balance sheet um, because they're borrowing to lend to other people. All right, so let's look at Goldman Sachs. Their stock chart. You can see has been an amazing uptrend since April, but recently with the market, it's been going in this sideways to down pattern. So it seems like right now we have a lot of stocks and um, indexes that we're following that have broken out of this uptrend and they're going into a sideways trend. Let's look at, so this is kind of neutral for us right now. It is going down, but if I was looking at this chart and thinking about investing in the stock, I would super dollar cost into it, maybe 0.3% at a time, seeing that it's in a downtrend. If there was a good reason to buy it. So let's look at CFRA, what they said about it. They said that they have a 9-month, 12-month price target of 910. I like to read this little blurb. They said we have a strong buy rating. Uh, it's a direct beneficiary of investment banking recovery in this year. Revamped strategy focused on core business and recurring fee revenue bearing fruit. Capital markets opportunity led by merger and acquisition resurgence and alt firms massive backlog needing monetization. Lower rate exposure with only 22% revenue from net interest income versus large banks at 60% to 70%. Okay. So the return on equity target is 15 to 17%. Okay. So I looked at their fair value calculation. They think they're overvalued by 13%. So that's a good red flag by CFRA that they're a little bit overvalued right now. If you look at the earnings, it's pretty inconsistent. You can see that we have 12, 16, then down 9, 25, 21, 24, 59, 30. So it's not up in a straight line. So it's not a truly reliable growth stock. Um, this is one of Jim Cramer's favorite stocks. It's in his charitable trust portfolio. And he used to work there. So he has a little inside scoop on the company and he understands it better than most people. So let's look at what Morningstar said. They said it's a price to fair value of 1.24. They think it's 24% overvalued. So that's kind of corresponding with our 13% overvaluation from CFRA. So that means for me, investing in this stock, I'll wait for a stock market sell-off for it to go down. And because right now it's still overvalued. I guess another positive for Goldman Sachs is right now there's deregulation with the current administration. So that's going to help all the banks because they'll be able to make more deals and there'll be less rules to follow. Um, this is the time of the year where 13Fs come out. Every quarter, we have updates to portfolios from every major hedge fund and mutual fund. And I thought it'd be interesting to go over Hendershot Investments top holdings. So Hendershot Investments was started by Ingrid Hendershot. She's a value investor, and I follow value investing a lot. And she likes to buy and hold for like long periods of time. I mean, decades. And so when she buys and sells a stock, I take notice. You can see that she's starting to reduce her meta. These are all the top decreases in her portfolio, and these are the top increases. So I thought it'd be interesting to go over those and why she chose to remove some of these from her portfolio. We know that Meta is spending a lot of money on AI that may or may not pay off, and she might be concerned about the debt. I mean, about the money amount of expenses Meta is incurring right now because Meta used to have a lot of free cash flow. Now they're spending a lot of their free cash flow on on the AI infrastructure. And Oracle is it's the same story. She might have been getting rid of Oracle because of that also. Um, let's look at some of the ones she bought the most. She bought Google, Alphabet, she bought Apple, and Johnson and Johnson. So all these stocks have been in uptrends, and she bought more Nvidia and the other type of Google. So it's always great to see stocks that we're following um, being bought by a very intelligent person like this. Let's look at their top holdings in general. This is very interesting. She holds right now 13.5% of her portfolio in Berkshire Hathaway. Berkshire Hathaway is only growing in their estimates like 3 to 5%. That's very strange that she would put so much of her portfolio in Berkshire Hathaway. Maybe she knows something I don't. And also, they're losing Warren Buffett this year. So they might have lost what made their company special and traded at a premium. So we'll see what happens here. But that's very interesting that she's buying a lot of that. And Google is a top holding in Apple and Microsoft, Visa, MasterCard, Nvidia, and Pepsi. What do these things have in common that I've highlighted there? You can see they all have similar monopolies. We have Google, they monopolize search. Microsoft, they have a monopoly in Windows and Office. Apple, they control um, hmm, they have a monopoly maybe in their App Store, and I don't think they have a monopoly. But we have Visa and MasterCard. They, of course, have 70 or 80% of the credit card market in the world. And NVIDIA, okay, they have a monopoly in AI chips. So she likes to buy and hold stocks for a long time. It's always great to check in on her portfolio. And sometime in the future, we'll look at TJX companies and some of our other holdings. Okay. So let's look at another 13F that came out. This is 0.72 asset management. It's like a hedge fund. And you can see that top increases in their portfolio. They this company is employing the an option strategy where where they buy puts on the indexes on a regular basis. I'm not sure exactly what they're doing. Maybe they're selling covered calls. Maybe they're um, doing some kind of market timing. But this is very interesting that they have in their top part of their portfolio puts in the QQQ and the SPY. They think the market is overvalued. This is very dangerous because um, if you hold as your top holding puts, that erodes over time. That value of this investment erodes over time, especially when the stock market is going up. So they put 5% of their portfolio in puts, which is very scary. So they think the stock market's going to correct in a major way. Um, they have, let me see, they have 1% in Meta. They have Broadcom, T-Mobile, Airbnb, HP, Hewlett Packard, Home Depot. Those are the ones that have bought the most this quarter. And the ones they sold this quarter, these are kind of, they sold Amazon, Walt Disney, Snowflake, Cisco, DHR. A lot of these are AI infrastructure. Let's look at their top holdings in general. So the top holdings are puts for the S&P and then calls for the S&P. So they might be doing some kind of mm, covered call writing or market timing or something like that. It's very interesting that 10% of their portfolio currently is in that strategy. Then NVIDIA, they have Microsoft, QQQ, Amazon, Meta. So a lot of the big tech stocks are their top holdings right now. So it's always great to know that the stocks that we're following are being bought by hedge funds. Um, see what other stocks are in here. We have Union Pacific, T-Mobile, Block. Okay. So I thought it'd be interesting to go over these. We'll go over some more next week, some 13Fs. And and that's all I had to say for today. I hope you enjoyed the talk, and I'll see you next week.